Hello and welcome to our latest episode of the Investing with IBD podcast. It's Justin Nielsen here, and as usual, we are live. That's the way we're doing things nowadays. It is September 25th, 2024, and joining us on the show today, we've got David Saito-Chung coming back, our resident hat man. And it's funny because we had David on 2 years ago for a special version of Don't Fight the Fed, when we were talking about how the unprecedented Fed hikes that we were seeing to combat inflation. This was April 2022. And David, you did a really good job of laying things out about the rate hikes and how history can kind of guide us. So we figured now that we've had our first rate cut, maybe you can come back and kind of share with us what we can expect. So thank you so much for coming on and joining the show again.
Hey, Justin, it's a privilege and an honor to be back again. And I really enjoyed that show we did. I can't believe it was more than 2 years ago, though. Was it?
Yeah,
Was it,
I
as
would
you
have
said?
lost that bet.
Yeah,
Time flies, right? When you're having
it really
fun.
does. It really
Uh,
does. And the amazing thing is that we're going to talk about 94, 95 as well, because based on some research we've done and the way the stock market is acting, it still may serve as a really good precedent for the stock market and investors in the months to come.
Yeah. Well, one of the points you made back then was that, as Mark Twain said, history doesn't always repeat, but it often rhymes. And yeah, there's some rhyming going on, and a little rap battle. So, but before we get into that, let's kind of cover where we're at in our market cycle, because it's been kind of a interesting. Interesting few months here, or even if you just want to go back to the start of this year. And I'll go ahead and start with the NASDAQ. That's where we usually tend to start. Wow, we had a really interesting August as the Japanese yen carry trade was getting unwound, and Google antitrust. I mean, it was just a whole host of things hitting the market as we came down here. Things looked like they were righting themselves, and then, man, September did not start very great, but we quickly righted ourselves, and then it was all breaths being held before this latest Fed meeting. And even though the initial reaction at the end of that day was negative, we got this gap up the very next day, and now we've just been kind of holding tight. So what are your thoughts on where we're at right now?
Well, you covered it just perfectly there, Justin. It was like welcome back volatility, but also welcome back Nasdaq 18,000. Right?
Mm-hmm.
We wondered whether, for instance, the techs would continue, the big cap techs would continue this amazing run over the past year and 9 months or so, and so far they've added to the advance, not taken away from it. Today's action was interesting, though, in some other ways, Justin. I just want to highlight, while the NASDAQ just inched higher, we were wondering if it could have been a stalling day. It looks like volume was lower, so likely not, which is good, because we still have something like 6 distribution days on the count, one that's
Mm-hmm.
going to fall off on Friday. But I do want to note that the small caps and mid caps, when I look at IWM, down 1.2%, and the MDY, which is a proxy for the mid-cap 400, down almost 1%. I was wondering, well, what happened here? It looked like a lot of energy, oil and gas, and banking stocks fell. So there was some interesting rotation going on today, Justin.
Yeah. And I mean, just since we're talking about some of those industry groups that have been kind of a little bit more volatile, I mean, utilities looked like they were possibly, pulling back a little bit. But here's XLU, which I should have mentioned that, I didn't even give your title. I just assume everyone knows who you are, but of course you're the deputy markets editor at IBD. And also you run the Leaderboard portfolio, which has included XLU for a while. So XLU right there at highs, like not showing much willingness to give up any ground.
Indeed, and let me just add that I'm pleased that I have a co-manager of the Leaderboard portfolio with Ken Shreve, senior markets writer. We've worked a long time together, and you've probably seen all of us, including Justin, on IBD Live together. And Indeed, XLU is sort of our little tortoise in the portfolio that hopefully will win the race over the long run. But
The
it's
little engine
amazing.
that could.
Little engine that could, right? And driven by this excitement and hype, if you will, and but also future prospects of growth through AI and the energy required to fuel AI. So, yes, XLU holding up quite well. The breadth in the market today, not so good. Like I said, it was due to just a large number of lenders that were down, particularly in the small mid cap space. And so we're going to watch that closely.
Mhm.
The last thing I want to mention too, Justin, is that we headed into today's action with nice double-digit gains for the S&P 500, the Nasdaq, but the small cap 600, the S&P small cap 600. So on a market surge, you can see that at 0 ampersand P6. I like to watch this closely because they say that this is a higher quality version of small caps. Well, it's also had a bad day, and it's only up something like 6 to 7% year to date. So where the leadership is still kind of tilted toward the larger mega caps.
Mhm. And then, just kind of to that point, a lot of times we'll look at FNGS to kind of get a sense of what's happening with those Mag 7 stocks. This looks a lot like the NASDAQ, but I think it's worth mentioning, the S&P 500, which of course has those big mega cap trillion-dollar companies, but it does have, what's often been called the 493, right? The
Mhm.
everything else. And this has been getting into new high territory well before the NASDAQ. RSP, which is the equal weighted version of the S&P 500, that's been no slouch lately. I mean, it got a little bit more of a hit today than the S&P 500, but this has been performing pretty well. So to your point about breadth, it really has been not just about the Mag 7 like it was for 2023 and even the beginning of this year. It really has broadened out considerably.
Oh, I totally agree. Not much to add here, Justin, other than one of the points that I'd like to make during our discussion about what's going on with the Fed rate cuts is that you look at RSP, you look at QQEW, you look at the NASDAQ 100, you look at the Dow. All of these indexes are either at all-time highs or within 2-3% of their highs. That is
Mhm.
strength, and that's something you have to respect as an investor.
And since we're talking about again the hit for IWM and MDY, the small caps and the mid caps, as you mentioned, you kind of explained it already. But usually, the first thing I look at when those get hit is the 10-year Treasury yield. So certainly, it's worth noting that the 10-year Treasury yield coming down is something that you would expect has really helped the smaller companies, right? That are a little
Yes.
bit more reliant on debt. This is, it's been up over the last few days, but still in an overall, pretty serious downtrend.
Absolutely. When you look at that jump in the yield today, right? I think it was around 4 basis points, which is not a lot, right? But
Mhm.
there's maybe a little bit concern about what the upcoming PCE inflation data will be like on Friday. Does that change, the course of the new monetary easing policy, and if so, how does that impact the smaller banks and smaller companies? But just like you said, the longer term trend is clearly really really bullish for equities.
Mhm. Um, this is kind of, I'm going to throw you a wild card here.
Do
I
it.
noticed that as I'm looking at the chat on YouTube, we do have someone saying, hello from Italy. Any notes on kind of the international space? I know you have experience covering international because you were a reporter in Japan
Right.
for a while, covering the markets there. But have you been looking at any of the kind of international space and getting any gauges from that?
Well, first off, I want to say a buongiorno to our friends in Italy, as well as those a few I know who listen to us on IBD Live every day. And funny that you mentioned that because I think it was yesterday, Justin. If we look at EEM, the ETF, which is the iShares Emerging Market that had a breakout,
Hmm.
and yesterday today pulled back, but it's still above a base high, which is promising. I think if you look at the weekly chart, you get a better feel for what is the sort of kind of moves it makes.
Hmm.
And these moves are not exactly, SMCI in 2003 or 2023 or Vistra this year. But it is another sign that we are still in a nice bull run. It's also interesting that these are happening amid a number of banks, not just the Fed, which cut interest rates by half a point last Wednesday, but the Bank of Sweden, the Bank of Japan making cautious comments about a future rate hike,
Hmm.
China with its multitude of interest rate easing yesterday. This
Yeah.
this is not by coincidence.
Yeah, very stimulative. One of the things that I think you were bringing up on IBD Live as you were hosting yesterday was maybe K Web, which had a phenomenal move yesterday. Was there another one that you were bringing up? I want to stay
Well,
away from the triple leverage that you you brought up.
yeah, that was brought up in the Q&A, but kudos to Ed Carson, our news editor. He was also on the show in that day, and basically, he looked at FXI. FXI is the iShares large cap China.
Uh,
Justin, that's been around a long time. It's not every often that you see a gap up like that by one of these diversified ETFs.
yeah. Yeah, very good. And it turns out we've got some folks from Sudan as well. So yeah,
Wow,
we've
welcome.
got audience members from all over. So good to see that. Um, anything else in the markets before we kind of move on to our historical precedent? Any kind of final thoughts there?
Well, I think it's interesting that according to our general market indicators page on investors.com, the IBD mutual fund index continues to lag the S&P and the Nasdaq. Last I checked, I think the index of 20 or 25 or great long-term mutual funds is up something like 14, 15%. So that's severe underperformance versus the S&P. However, a few of the components, whether it's Contrafund and some others, have actually done even better than the S&P. So I think that's really what's really interesting about this year. Uh, I don't think we talk much about utility stocks at the beginning of the year. Now we seem to talk about them every day, and so I guess the message from the market could be, keep an open mind. You really don't know where the parade of leadership is going to come from.
Yeah. And it maybe kind of speaks to the difficulty that this year has been. Here the professionals are struggling to beat the S&P 500, and there's a lot of evidence that that's a constant struggle to beat that bogey. But this year has been particularly, I think, tough from even some of the best that we have in that IBD mutual fund index. Yeah, let's go ahead and turn our attention for this next segment. We can kind of focus a little bit on this historical precedent because certainly the inflation, initially being called transitory, and then it was, oh, okay, this might be a little bit more sticky. That kind of led to a very very sharp rise in the Fed funds rate. We saw. A big move from, I mean, basically zero for that Fed funds rate
Hmm.
to a huge increase, multiple increases, putting a lot of pressure on people that were borrowing money and companies that were borrowing money. And of course the goal wasn't to make things harder on people, it was to tamp down inflation. That was the big concern. Now that inflation is kind of subsided, CPI, what did it top out at? Over 9%, and now it's getting closer to that 2% target. A little bit of softness maybe in the labor market that we weren't seeing before. And so a lot of questions in terms of when was it going to happen. Finally did happen, and then it was going to be, how much will this first one be? And I think it was for a while 50-50. Were we going to get a 25 basis point cut or 50? And we got 50 this last Wednesday. So what what can we learn from the other side of things? Because I'm just going to go back in time here and put the S&P 500, or you know what? I think we used the Nasdaq before, David, when we were
Yeah,
looking at this
let's do that.
previously,
Sounds good.
and we're going to go back in time to 1996. Take it back to my college days, and here we are. We had in 94, 95 this pause, really, and this was during the rate the rate hikes that we were seeing to kind of tamp down inflation, and
Hmm.
slow things down a little bit back then. And then we started getting a rate cut cycle. There were three cuts, to what was kind of referred to as a mid cycle, and it was kind of off to the races. So what can we learn from this, do you think?
Well, a few things I sort of prepped for this podcast, Justin, is one is when I looked at the actual record of what the Fed did and what the market did. It's interesting that we had a follow through in mid December of 1994, and that was before the Fed made its final rate hike. Believe it or not, the final rate hike actually took place in 1995, February 1st,
Yeah, that's right,
and
right here.
yeah, and that completed basically a 300 basis point increase in the Fed funds rate. We went from 3% to 6%, but the market was ready to rumble in a good way
Hmm.
before the that last hike that took the Fed funds to 6% from 5.5. So it's interesting that the market, had anticipated a rate cut for a while. If you consider the stock market action since January as an indicator of what the conditions could be like in the future. And of course, 2023 was all about hopes that we wouldn't have a hard landing because we were basically kind of holding in a holding pattern regarding interest rates from July of 2023. So I think once again, the market has proved that it really knows what's going on, and you have to
There's a
just
reason it's called a leading indicator, right?
leading it exactly. Yeah, that's right. That's right.
Uh-huh.
And so uh, we are looking at a weekly chart, right? Okay,
Yes.
so
Mhm.
yeah, I think if you go to can you go to a monthly chart at this point? I
Sure.
think you can
And I'll just
really
real quickly kind of mention that
yeah,
when the rate cuts started, that was in July of 1995. So I think right around
that's
here,
right.
if
Hmm.
I'm not mistaken. Yeah. So July 6th, 1995. So that's when the rate cut started. There were three 25 basis point cuts. But let's go ahead and go to that monthly,
Exactly.
as you
Yeah.
mentioned.
Yeah, and I think it's really cool to see how after, a very long correction, not a deep one, but a long correction was really good for the market, following that big run up from the end, the bottom of October 1990. It was kind of the true pause that refreshed, and that monthly chart really shows month after month after month of gains from December 1994 through pretty much the end of 1995 and then a few months after that. So I think it was interesting. We didn't take at least the Fed didn't take the Fed funds rate all the way back to where it started, which was at 3%.
Mhm.
It only went down uh, to I think it was about 5.25. Yeah.
Right.
So, but because that's kind of similar to where we might end up in 2025 now that we've started a rate easing cycle after 11 rate hikes that started in March of 2022, going from a range of 0 to a quarter percent all the way up to 5.25, 5.5%. Some people make a big deal about that first half point cut, right? That
Mhm.
wow, well, they really wanted to get things started, and from the news conference that Jay Powell said, I think it was really important for us to remember that he made it clear that they don't want to be behind the curve, if you will. if the economy really, really slows down. So that comment was really interesting because it kind of showed he acknowledged that maybe they were a little bit late to tamp down inflation by raising interest rates, but they did it and they've succeeded now in, as you said, cooling off inflation. Now they want to really be on top of this next cycle in which they can allow that magic formula for stock markets, which is low inflation, low unemployment,
Mhm.
and good earnings.
Yeah. And it's worth noting, here's a monthly chart of the current market. You know, very very similar. As we saw with this latest rate hiking cycle, very similar to the 94, 95 in terms of this kind of drawn out bear market. Um, it doesn't look so bad, but man, you had Nvidia down 60%. You had the ARK Innovation Fund down, what was it? Over 70%,
Maybe
80%,
maybe
so
85, right? Right.
85%. Yeah. I mean,
Yeah.
growth stocks really took a beating during here. So what typically happens when you start the rate cutting cycle? What's typical? We don't want to just use a sample size of one. Here's what happened in the 90s, because that's not always, there were a lot of things that were different about the 90s, right?
Sure.
So what is the typical response when that rate cutting cycle starts?
Well, it's a great question, Justin. And for this podcast, I happen to find a very nice front page article in the business section of the Wall Street Journal. This was actually on Tuesday. The title of the story: "Rate Cuts Tend to Bolster Markets," and they had 7 examples of past times when the Feds, started to cut rates, and 5 of those instances, there was a gain in the S&P for over the next year. There were
Hmm.
only 2 times when the market was actually down, despite the fact that the Fed began a rate cutting cycle. Just doing simple math, I found out that the average gain over these 7 instances was 7.2% for the S&P 500 over the next year, which is sounds moderate or modest, if you will. But if you are a stock picker and you can find leading stocks, you could obviously do much better than 7%. The the other point I want to make that is, and some people have made a big deal about this, is that we had a 50 basis point cut. That was just like what happened in 2001 and also in 2007, September 2007, before the great financial crisis really uh, uh, took hold on Wall Street in 2008. Those 2 cases, we saw 50 basis point cuts, but I would argue to say that it's a different situation this time. 2001 was the start of a major tech bubble crash, right? And that tech .com bubble, in hindsight, could have been compared to the South Seas bubble or to the
Right.
Dutch tulip craze.
Hmm.
And then when you look at 2007, 2008, well, here again, the subprime debt bubble, unleashing some serious damage to Wall Street. We're not seeing the same situation in 2024, and
Hmm.
therefore, as a reporter, as a journalist, I would think that history is more likely going to repeat the more positive instances that was covered in this really nice WSJ article. Also, Justin, let me just add another stat that was really impressive that we saw, I think, on CNBC. Ryan Dietrich, a longtime equity strategist, he's now at the Carson Group. He was at LPL Financial a long time, and his team looked at 20 instances when the Fed cut rates when the S&P 500 was within 2% of an all-time high on the day before that rate cut. And in every single case, 20 cases, the 500 index was up and the average gain was 13.9%. So
Wow.
yeah, so that was very similar. I mean, well, that's what we experienced just on September 17th, the day before the September 18th 50 basis point rate cut.
Hmm. So just to kind of put, for those folks that are watching this, again, some of you are watching live, but let's let's kind of take a look at the picture that's worth 1,000 words here. So if we go to our third slide, if we start there, the federal funds effective rate long term. So we'll go forward a little bit. Yeah, here we go. So this kind of this goes all the way back to 1955, David. So this was something that you provided for us. This is, of course, from the federal funds effective rate from the the Board of Governors of the Federal Reserve System. This is from Fred, the St. Louis Fed. And man, you can see how, I mean, that cycle that, I mean, of course, the 80s was so crazy in terms of how high when Volcker had to really break the back of inflation. But since 2000, we really have been in this very low rate cycle. Again, as you mentioned, we kind of had to do something stimulative after the dot-com bubble. And then, let's not forget 9/11, kind of happened right in the middle of that, where it was,
Yeah.
let's stimulate the economy. And then same thing, we went to zero basically, as a result of the housing bust, when it was like, look, the financial system almost, ground to a halt. And so we got to get people, using credit again, and, trusting each other again, and all of that. So, given that kind of backdrop of how low we've been for so long, I mean, it feels like we were so high at 6%, but historically, going back to the 50s, it really isn't that high. I mean, for the last 20 years, it's high, but
Yes, absolutely. Well said. This is one reason why we love to study history, especially over a long period. Yeah, we weren't going to talk about the Fed and the stock market in the 50s or 60s or 70s, but I think the way you framed it was great. And for sure, when we look at this long-term chart, you have to wonder, well, are we ever going to go back to zero, right? That's always going to be asked a lot. And I think a lot of central bank governors and former Fed governors have said most likely not. And there are some important reasons that could be addressed in a future podcast, and that's regarding the debt, the huge debt, 28, 29 trillion in U.S. Treasury debt that's out there. I think it'll be interesting to see, in the next year or two, where that 10-year Treasury yield goes. I think for all of us as investors, it's very important to keep an eye on that. Not just simply what the Fed is saying or what they're going to do, but what uh, market participants in the bond market, and what they do with their real money. And as they like to say, the Fed does not have control, or at least direct control, over the long end of the Treasury yield curve. In other words, 10, 20, 30-year bonds. However, what was also interesting is that in that September 18th announcement, the central bank made no change in its uh, un, un, what do you call it, a runoff of
Okay.
mature debt securities on its balance sheet.
Hmm.
In other words, the so-called QT, or quantitative tightening, is
Right.
proceeding at the same pace as it was before this initial rate cut. We are at 7.1 trillion in debt-related assets on the Federal Reserve balance sheet as of today. And the peak was around 9 trillion. So they've actually made progress in letting the matured Treasury and agency-backed mortgage securities to just run off the balance sheet.
Right.
And they're making profits of it, which is actually good for the bank. But if they continue the current rate, which is something like around 60 billion a month, then we could see by the end of 2026 that Fed asset balance sheet down to around 5.5 trillion, which
Hmm.
is not far from pretty much the peak that we saw in the Fed's balance sheet in the 2010s. And there's a lot of numbers I just threw at you guys, but it's very important to keep that in mind, because when they're selling the treasuries, there's someone got to be out there to buy them.
Yeah.
And a low low interest rate environment for the U.S. benefits pretty much all parties, the investors, especially from those overseas, invest. It benefits corporations as they borrow to acquire other companies, to invest in R&D, to increase stock buybacks or pay dividends, and also it makes equities competitive as an asset class. So,
Right.
the 10-year Treasury yield is going to be something I personally going to be really watching closely from here on as well.
Yeah, of course, it doesn't benefit everybody. The typically when you have the low rates, it always is kind of a rough time for savers, right? If you're holding cash, if you like to save cash, that's where it's not as good for you. But that's why it has that stimulative effect, right? Because it's,
Hmm.
hey, I'm not getting a good return holding my cash. I better use it for something. I better invest it elsewhere where I can get. And to your point, yeah, the runoff, as these securities mature, just by the nature of not, rebuying, it reduces that balance sheet. And that's incredible. I hadn't been paying attention to what some of those numbers are, but it's good, really good context that you're giving there. If we can kind of go to the slide before this one, just to kind of give a little bit of a more near term look. This is
Yes.
kind of our short term look here. And this only goes back to 2020, and I think it's worth mentioning that these, when you say, are we going to go back to zero again, the going to zero wasn't good, right? It was kind of emergency procedures, like ejection seat time where it was, it's not a button you typically want to press, but we
There we
had
go.
situations where with COVID and
Yeah.
with the housing bubble where the Fed did kind of put that, hit that emergency button, and did bring rates to that very, very low level. So anything that you wanted to kind of mention on this one before we go on to our next slide?
Well, I really like the way you framed it, Justin. Uh, Not only did the Fed go to zero on the Fed funds, they went, crude oil went below zero. That
Yeah,
was a
right.
crazy time, right? The futures on the crude oil
I will pay you to take my
to
oil.
take my oil. And then, in a way, you could argue that the Fed went below zero in terms of interest rates because they backed up. It created all of these credit facilities, short term, temporary, but facilities to make sure that people didn't throw all the corporate debt out the window, which
Yeah.
could really lead to some incredible economic depression amid a 100 once in a 100-year pandemic. So
Mhm.
incredible times we have lived in. Just when we thought, like, 9/11 and the great financial crisis were bad enough, 2020 was quite something that we all learned from and survived,
Mhm.
which is great. And the uh, the the other reason why we wanted to show this slide is because of your astute observation that, hey, okay, if the announcement on September 18th shows that by the end of the year the Fed FOMC committee members believe that among the consensus, where will the Fed funds rate be? Well, right now, I think they're predicting between something like 4.25% and 4.5%. So if you look at that chart, that only goes down a certain amount, and then if you go to the end of 2025, they're thinking 3.25% to 3.5%, which is still well above that 0 to 0.25% historic low level.
Mhm.
Uh, the other thing that we want to look at right now, exactly, this is the other uh, chart that or table I wanted to share with everyone, is that in the beginning of the year, uh, the the bond market predicted that we would have something like 6 to 8 rate cuts, whereas the Fed, during its dot plot a year ago, predicted only 3 to 4. It looks like the Fed is pretty much more accurate about itself than the market.
Right.
you know,
Yeah.
and if you look at this closely, you'll see,
Powell was saying this is what we expect to do,
right,
and the
right.
market just didn't believe him, right?
They didn't believe him. Yeah, exactly. And so, now, of course, now I've talked to some people on Wall Street, and they said, yeah, we don't believe what the market believes either.
Mhm.
We and some bond investors got hurt by buying too early. Fixed income bonds because interest rates actually rose. We had 3.73% on the 10-year earlier this year, and so or excuse me, not three. Was it 3.7? I think it was actually 4.3. Excuse me. We're at 3.7 now, but now if we look at this slide here, it's just the gist of it is that the majority of bond traders who deal with the Fed funds futures think that we are at the minimum, at the maximum, going to be at 2.75 to 3%. Who knows whether that's really going to happen? In other words, this chart is saying the Fed still has it wrong about the economy, that we could still have a hard landing, and therefore they might be forced to push rates quite lower than they even think. Now, 0.4% chance of the Fed funds rate at 2%. I mean, we could kind of ignore that. We kind of can ignore 2.25. But you're really, 2.5% to 2.75. There's at least a third or
That's not
close to a
nothing.
third. Yeah, and
Yeah.
well, I personally, I don't know if I agree with that right now. So just know that, right, that the market itself, at least from what we've learned about the Fed funds, can be wrong.
Yeah. So to kind of tie a little bow on this, because again, this might be something that folks have to watch again, because it's not always that easy to kind of parse everything about the Fed. But it's something that we talk about a lot. Don't fight the Fed. The Fed is more stimulative in that kind of cutting mode now. So just break it down. What does that mean for me as a stock market investor?
Well, it means, first of all, keep watching what the stock market is doing. We always use that as our ultimate guide, and I think the stock market will still continue to respond pretty dramatically to any key economic data, such as what's coming up on Friday with the PCE index, and how it could affect the Fed policy, because I think right now the market is respecting the Fed, and you know as the title of our podcast is about, you don't want to fight the Fed, you don't want to fight the trend that's been clearly laid out in front of us. To keep an open mind to also not only the improving conditions for equities, but also still look for what's new within the stock market in terms of uh, new growth in a sector, new highs, new issues within a sector, new innovations, because we're going to go over a few stocks that really illustrate that exactly, and may or may not have that much, direct connection to what the Fed will do, in November, December.
Mm-hmm. Okay, so Dave, it's time to shift our attention to stocks,
Okay.
because it has felt a little bit better that there's been more stocks to choose from. And I got to say, Leaderboard has been making some great choices. I'm going to start with, since we're talking about the Fed and everything like that,
Hmm.
let's start with this gold miner, AEM, Agnico Eagle Mines. This is something that you put on Leaderboard, and it's had a nice run here. Who knew that gold would be going right along there with the growth?
We're really happy with this three-quarter size position in terms of the Leaderboard portfolio, and I really appreciate the opportunity to talk about this. Specifically, you got the daily chart on there on market surge, and we started looking at gold stocks after we had more discussion about it on IBD Live. Not necessarily AEM, but a number of them. We all know gold's had a great year, up almost 29% year to date for the near term gold futures. If I look at today, I think gold also had another nice day. The December contract at 2,681 per ounce. So AEM, Agnico, is a company with excellent IBD ratings, 97 EPS ratings, so in the top 3%. And it joined the portfolio on July 3rd as a half-size position, which is roughly 4 to 5% weighting within the portfolio. That price entry was at 68. Just a week later, we added another quarter. We trimmed that, and then we raised it back to a full-size position on September 12th. On September 12th, that price was at 81. So the half position add hasn't had that much progress, but the initial half position at 68 is close to a 25% gain. So we're very, very pleased with the way it's acting. As Justin's chart shows, you can see that it's had some tests of that green moving average, which is that 21-day exponential moving average, as well as the 50-day. And leading stocks are going to pause and take a break, succumb to a little short-term profit taking, but then re-energize themselves with some new highs. And that's exactly what AEM has done.
Yeah, and you can't deny that, again, a very good gauge of how powerful a stock is. You always want to see this relative strength line in an uptrend, because if this is going flat, then it's like, well, why should I bother going with single stock risk? If this is going flat, that means you could get just as much of a gain from the S&P 500. But as we saw, this had a very early start on that relative strength line, and even though it's been kind of going a little bit sideways here lately, it's still well up there in terms of its performance versus the S&P 500. Another
one more comment. If I, I love showing props, right, during these podcasts, and just want to highlight this is the latest issue, of the IBD Weekly, the Big Cap 20, and you can see I highlighted AEM number two in the Big Cap 20. You can see the list updated every day on investors.com under stock lists. Under the main navy bar, there's stock lists, and then under that, Big Cap 20. So this is one source of our stock ideas that eventually become leaderboard names too.
Yeah, computer generated. It's one of those things we've got, kind of a lot of algorithms that will kind of identify based, on certain factors in our database. And yeah, as you said, it's a great list, and something that we have available for subscribers, or if you get that weekly version, you can take a look at those charts with chart analysis. A lot of times you are doing the Big Cap 20 chart analysis, yourself. You kind of man that team that gets those chart analysis done. So yeah, it's a great thing. Let's also take a look at DoorDash. This is another leaderboard stock. Nice little breakout here at 131.21. What kind of got your attention on this one?
Well, full disclosure, I also own shares. I hope
I do too. Thank you for reminding me. I do own shares myself. Yes.
Yeah, good. Yeah, we go cover all the complaints. And let me first say that initially, this stock entered the watch list of Leaderboard on August 13th. We even have the actual time of day, 11:35 a.m. And then about a month later, in fact, exactly a month later, on September 13th, it was added as a half-size position with an entry price of $132.60. So we're pleased with the progress. It's up 10 points since then. Another quarter position was added soon after that initial half position. I have to say this, that two things. One, Justin, it's not only the current technical ratings, which are really, really good, but the fact that I personally like looking for companies that have good sales growth and are just about to turn profitable. And for that reason, the EPS rating is not very good, but the prospects of the company becoming a major earnings generator is there. And so if I look at market surge, this year they're expected to earn a penny a share, dramatic improvement from a net loss of $3.68 just 2 years ago in 2022. And then for 2025, the calendar year, Wall Street is expecting earnings of $1.62 a share. So big change there. But also, I happened to see one of the co-founders on a past episode of Shark Tank, and I was wondering, who is that guy? I've never seen him on the show as a shark on that Shark Tank show, and turned out to be one of the co-founders of DoorDash. And
Hmm.
he spun a very good yarn of why they've been very successful. Uh, the second reason why we consider this closely is because we had some success, or maybe not Leaderboard, but we've noticed the success of Uber. UBER, as also a nice growth stock, really a leader within the transport space.
Mm-hmm. And I do have a position in Uber myself. It's also worth noting that there was some news out today on, I believe there's a lawsuit in terms of whether or not a lot of these companies like DoorDash, Instacart would have to share
Hmm.
information about their customers to the restaurants. And that was kind of uh, determined, that no, due to privacy issues, that was not something that needed to be shared. And it seemed like here's Maple Bear,
Yes.
which is Instacart, and Dash both did seem to have a positive reaction, to that. So definitely worth noting there, and something that we were talking about on IBD Live today. So you are often giving the news for folks. So that's something we do 10 minutes before the market open, every day, and go for a full 90 to 100 minutes. I should also mention that you referred to some times, in regards to DoorDash, and that's referring to the alerts that subscribers get when something joins the watch list or joins the leaders list and becomes a part of that model portfolio. Alerts can be obtained either on your desktop via email or through push alerts through our Leaderboard app. So one of the great parts about that service is those alerts are coming kind of real time, within minutes of you hitting that button, or I should say seconds of you hitting that
Sometimes
button.
seconds. Yeah.
Those alerts come out. One more member of Leaderboard, this is probably not something that a lot of people have heard of. This was
No.
certainly new to me, and I'll be honest. There's been a number of times where Leaderboard has given me ideas of stocks that I wasn't aware of. I will say that the first one that I really scored big on was a stock named Invensense that had skipped my radar
Uh-huh.
because it was under $12 at the time that Leaderboard put it on. But in 2012, when I bought that, it was my biggest winner of that year. I think I was up 70 or 80% on it. They were the
Wow.
makers of the gyroscopes for the Wii, gaming platform. And that was something, of course, that my kids were using at the time. I think I might have thrown my shoulder out playing tennis on that Wii at one point. But
Oh gosh.
and Ensign Group, and just to be full disclosure here, we were arguing about for a little while on how it was pronounced. Ensign, like the
The boat
rank
class.
in the Navy, or
Oh,
is
right.
it Ensign? We did discover it was Ensign, but
Yeah.
yeah, this is not usually what you think of as being that sexy long-term care, but hey, you can't argue with the results here.
Absolutely. And a lot of credit goes to one of our special, very, very special guests on IBD Live, David Ryan. He started talking about the long-term care stocks, not just ENSG, but SBRA and AHR, NHC. There's a number of them. But Ensign really appealed to us the most because of the chart showing what we thought was real evidence of institutional demand. You can see before that breakout past 127.58, there were numerous up days and heavy volume in June, July. And then, yeah, the breakout occurred in nice heavy volume. Now, the relative strength line took a little while before it hit new highs, and that on Justin's screen is the green line. And then, but it really shot up, and then the moving average of the relative strength line. Basically, I think we're using the 21 and the 50-day moving averages for the relative strength line. They started to showing some bullish action too. So it's been a smooth ride for Leaderboard, which added it as a half-size position July 10th at 129.50. So now we're talking. Now we're thinking about, okay, when will we see a defensive sell rule, such as a sharp cut of the 21-day exponential moving average, which could spur a trim of the position, or an outright undercut of the 10-week moving average on the weekly chart, particularly on heavy volume. whether that could be the sign that, okay, these nursing care stocks are ready to go into a correction. Clearly, we all know, right, that America is aging, and the needs of our elderly are growing. It seems like the private sector, has helped deal with these issues, and some also grow the revenues and earnings, making it kind of like what may be a win-win for both the consumers, the government, and the corporation and the shareholders themselves. Can't argue with the chart, especially when you look at that weekly chart that Justin shows. That green line with the vertical hash marks show very, very steady earnings. Very, very good stuff right there. And you can see the estimates are strong going forward. So at this point, our suggestion is to keep watching that stock. Don't chase it, but maybe look for that pullback to the 10-week line as either a potential follow-on entry, or if it's a very, very negative action, a time to take profits.
Let's go ahead and give two stocks that you're also keeping an eye on, and it's probably worth chatting a little bit about the home builders. This is NVR, which probably scares a lot of people off because it has this $9,500 price, and so people are like, well, gosh, I can't buy 100 shares of that. That's way too much money. But if you have 20,000, let's say, you buy 2 shares. If you have 10,000, you buy 1 share. So what is it about NVR that would entice or should entice people to maybe give this a go?
Yeah, great questions, and you know, I think people can benefit from watching these interest rate sensitive sectors such as the home builders, which have had a big run up already, even though we just had the first rate cut in 4 years, right? It's amazing when you look at that NVR chart, an initial breakout taking place around the 6,500 level, and now we're at 9,500. For those who are patient, even if you had just a few shares, that's a really
Hmm.
remarkable percentage gain, and it's often not just how many shares you own, but like how much do you own in a leader? That's more important
Yeah.
to make your year, right? So we're not suggesting this stock as to just go in blindfolded and just buy and hope and pray. Um, you know, I wanted to talk about this one briefly because I think it's the best stock within the home building group, and there are a lot of good home building stocks that we could go through. My suggestion is to keep an eye on how it acts around the 21 and the 50-day moving averages. It might make a new base just like it did in the spring, the early summer, and also keep an eye on some of its other peers because yeah. Certainly, one share being 9,000 can be prohibitive, but there are a lot of other good companies in this group that we should watch.
Hmm. And one more stock. Let's take a look at Mercado Libre. I do have a position in this myself. Fairly tight action here recently after this nice move. What's exciting you about this one?
Here again, since we talked about emerging markets, I think it's exciting. One, Justin, that Argentine stocks have been the toast of the town, if you will, especially in Latin America, with the reforms that are being led
Hmm.
by the new president Javier Milei, and you see Mercado Libre has a lot of business in Argentina, obviously in other countries too, Brazil and
Hmm.
Colombia and so forth. But from what I can tell, among large cap stocks, this is a rare gem. If you want to invest in the future growth and recovery of the region, and this breakout really wasn't a very pretty base. I'll say that. But when the stock came back toward 1800 in May and then fell, came back up to 1764 in July, then fell. It probably really not only scared people out but wore people out. But that's the nature of the market. It can fool you once and then fool you twice and maybe fool you a third time. But if you really like the company and you see the stock showing a lot of the metrics that we're looking for potential leaders, you just have to just you know be determined to wait for that ultimate breakout to happen. And I think people who kept watching the stock and bought as it crossed 1800 and did not pull back have clearly been rewarded. If we look at a monthly chart, this is it's proof that the stock it's been in my view, a true market leader. When you go back to breakouts, certainly very, very choppy action, whipsawing, tough to hold. But some of these earlier breakouts have led to as big as tenfold gains, and that's really impressive. And if you want to find a stock that can double or triple, you got to first see if it can do that. That's really important to find out. 108 billion market cap. This is a fraction compared to the Magnificent Seven as well.
Right. Yeah. And yeah, as you mentioned, when a lot of times, when you have companies that are embracing, and not companies, countries that are embracing a little bit more of the free market system, you might have some pain in the short term, but there are often some long-term benefits, and you see that kind of trickle into the stocks. We're complaining about our inflation at 9%, and I think the last inflation reading for Argentina was, I think 237%, if I'm not mistaken. But
It's up there.
On the way down from its peak, that was near 300%. So, hey, David, really appreciate you coming on, sharing your thoughts on the Fed, kind of giving us that update. Might be something I'm going to have to watch again just because of all the numbers and figures, but I think a really good gauge of what we can expect. And I think it's a rosy picture you painted, which you're an optimistic guy. I like it.
I appreciate it. No, it was great discussing all these issues together, Justin, and perhaps we'll address the market again when we are near the end, possibly, of this easing cycle. We'll see. It's going to be interesting to watch.
Yeah, we'll do a recap, right? How did things come out? Were we on par for those phenomenal averages that you gave? So yeah, that'll be interesting to watch. So thanks a lot for giving us your research.
Thanks again, Justin. Really
Okay.
enjoyed it.
That's going to wrap it up for us this week. Thank you so much for joining us. Really want to give a special shout out to the folks that were joining us live. Again, great to see some folks from the international spaces and some of the conversation that was going on there. But don't forget, you can always get this at investors.com/podcast, where you can also subscribe with your platform of choice. If you are watching this on YouTube, do us a favor, hit that like button. It helps tell people that, hey, this is something that is worth watching. And speaking of worth watching, I did notice in the comments some people asking about that old son of a gun, Arusha, who's been missing for a while. He's going to be coming back next week. And we are also going to have a special guest, John Najarian from Market Rebel. He is a great person to talk about with options and get his take on markets in general. A lot of great insights we get from him and his years of experience, being on the floor of exchanges and everything. So it's going to be great to have John Najarian back on and Arusha back. So hope you join us for that. Thanks a lot for watching this week. We'll see you next time.